financial information or accounting information for decision making. Managers for operation of the business, for planning of for the business, expansion of the business, shrinking the business. All these issues are within the decision, which comes partly as a result of information which we receive in financial statements. Some of you remember Mouse's. This is a shop similar to Bunnings Warehouse, belonged to Woolworths. It was a huge business across Australia, but suddenly they collapsed. And the owner of this business, indeed, was Woolworths Group. How they come to this decision? Because looking at the financial statement, this is not a profitable business. This just brings loss to the company, so we should get rid of this business. So the managers are those who receive this information, analyze this information, and make this decision that we need to shrink our business. Or when it comes to other operation for Woolworths, they found perhaps they need to open a new, say, shop in a new suburb. So that is an expansion. How they can find it? Through the partly through the financial statement and financial figures which they have in their financial statement. Government regulators, ASIC, ATO, Australian Tax Office, all these are organizations which directly use financial statements for their own purpose. Obviously, for tax office, you know very clear why they use financial statement to assess, to evaluate the income statement of businesses. For ASIC, that is Australian Securities and Investment Commission, this organization, or this government organization, indeed is responsible and in charge to make sure that companies and organizations follow the corporate rules and corporate regulation correctly, including the accounting standards. Employees and unions. For employees and unions, the financial statements are an evidence to claim for increases in their wages and salaries, or stop them from asking for increases in the wages and salary. And this is very common everywhere, in every organization. Is for-profit organization, not for-profit organization. Everywhere we can see these users indeed that using financial statement to claim, for example, for increasing in the salaries. It was a few years ago, and some of you may remember that Qantas had very bad time. It was close to collapse. And the new CFO, which still is in charge of this organization, started to negotiate with the unions and ask them to stop and freeze their wages for a few years, or otherwise he has to shrink the number of employees and staff. Then union decided, okay, we wouldn't ask any increases in the wages and salaries for say 10 years, but you have to stop any, sacking of staff and firing the staff. And this was an agreement. How they come to this agreement? Because union knew that the company is not in a good situation. The company is not in a good position, financial position, based on the financial statement. Therefore, they decided to stop for asking for any increases in their salaries and wages. Although that was removed, I think it was last year, because Qantas now turned to be in a good position, profitable, and even increasing the salaries of these employees. So the conclusion is that how this union and employees can use financial statement for their claim for increases in the salaries and entitlement. Competitors. Competitors use the financial statement to understand the weakness and strengths of the competitors. So they can use their experience to apply or prevent of any bad things to happen to their businesses, or using their strengths to improve their own businesses. So this is the way which competitors can use financial statement of each other to improve their business and to make a better position for their own business. Customers, that is important for customers to make relationship with the company which is sustained, the company which is stable for the future time. So it is important for a customer to make sure that supply of goods and services which is expected is coming without any problem in the future. So it is important for customers to find out about the position of the supplier in the form of the financial statement, stability in the financial statement, and good position of the financial statement of the suppliers. And on the other hand, we have suppliers that for suppliers is very important to know about financial position and financial performance of its customer, because they sell on credit, they expect to be paid back. So if a customer is not in a good position, financial position, or in a good financial performance, obviously that would create a risk of loss as a result of these trades. So in this way, supplier can use financial statement for a better relation, a more secure relation with their customers. All right, now let's go to the conceptual framework. We mentioned earlier, what is the conceptual framework? Basically, conceptual framework is a theoretical foundation of accounting standard and accounting practice. To understand the position of the conceptual framework to accounting standard and accounting practice, assuming that we want to build a building, what we should do? We start with a foundation, with the good structure for the building, and then construct on this building. Because if we don't go with a proper foundation, then we would have a risky building later on. So conceptual framework works in this way. Lays a very solid foundation for accounting standard and practices which we want to work on later on. In which way? In this way, that without using conceptual framework, if I ask any of you in regard to what does mean asset to you, every of us may have one definition of assets. If I ask about the liability, the same way, owner's equity, revenue, and so on. So it can be in a real life. When we do accounting, you are a chief financial officer, so your understanding of asset might be in a way which is different from me, which I'm chief financial officer in other organizations. So this doesn't work. In accounting, doesn't work. So we need to establish a foundation. That foundation comes through the conceptual framework. That's a theoretical base for the accounting. In this theoretical framework, we would have a clear definition, for example, for our accounting elements. When we talk about assets, the definition for me, for you, for everyone is the same. So whether we do accounting here in Australia or whether we do accounting in India or whether we do accounting in China or the US, doesn't matter. We have the same understanding of what is asset and how should be measured and how should be reported in a international context. Is conceptual framework the same as accounting standard? No. The conceptual framework comes in a very broad base. It says what is assets, but it doesn't go to type of asset because we do have many types of assets. We have inventories, we have intangible assets, we have property, plant, and equipment, we have investment, and so on. So the conceptual framework doesn't go to that detail. The conceptual framework just defines what is asset. And then when we go to accounting standard is specifically talk about a particular asset, how we can recognize a particular asset based on the definition which we have in the conceptual framework. So what is asset? If we want to find this definition, we go to the conceptual framework to see what does mean asset in accounting. But when we want to determine what is the value of our intangible asset, what is the value of our inventory, how we measure the value of inventory, then we have to go to accounting standard. So that is very broad, talking about asset. When we go to standard, we have accounting for inventory, accounting for intangible asset, accounting for property, plant, and equipment, and so on. So this is the relation. So it is not equal to accounting standard, but it supports accounting standard in this way, which I explained. The other usage of the conceptual framework is that in real life, sometimes we might face with a transaction, with an accounting event that somehow is not covered in the accounting standard. So how we can deal with this type of transaction? You're chief financial officer of your company. You need to make a decision. You need to advise your board of directors that what we should do with this particular transaction. In this case, then we have to back to the conceptual framework because accounting standard does not specifically talk about this particular type of transaction. Then we use conceptual framework. Sometimes we might find a contradiction between accounting standard and conceptual framework, although this is not very common, it's very rare, but we might face with this situation that these two, document contradicts each other. What we should do, the legal requirement for the accountant is that we have to follow the accounting standard. So that is when we have this, issue between the accounting standard and conceptual framework. Later on, in more advanced accounting units, you will learn about some of these issues that when we are supposed to make a professional judgment because of this contradiction and to deal with the issue according to the advice which we have. All right, what issues are covered under the conceptual framework? There are a few issues. There are a few major issues. The first things which we can think about the conceptual framework is answering to this question: who should report? The conceptual framework is defined that it has to be a reporting entity. We will talk about this reporting entity shortly. So not all entities must follow precisely the accounting standards, assuming that the corner shop obviously is an accounting entity. But does this corner shop has to follow all details in the accounting standard? No, because it's not a reporting entity. We will define about the reporting entity. So who has to report? That is a reporting entity. Why do they have to? that is the purpose, that is the objective of financial reporting. That is something that we go through again shortly to define what is the objective of financial accounting and what should be reported. That is the content of our financial statement. Which financial statement should be reported and what items should be reported. That is something that we go through this document. All right, objective of financial reporting is defined in the conceptual framework in this way, that provide financial information about the reporting entity. So you see that is very clear that which entities should report financial statement according to the accounting standard. That is the entities which are considered to be reporting entity. And that information should be useful for the decision makers. Who are the decision makers? We just mentioned about the decision makers, that 8 category of decision makers to make decision to provide the resources to the entities. We talk about investors, we talk about lenders, we talk about customers, we talk about suppliers. So all these say parties are parties which provide resources to business entities. And in regard to reporting entity, what is a reporting entity is defined as entities whose financial information has the potential to be useful to entity investors, lenders, and other creditors who cannot be directly obtain the information they need. So when we're talking about a company like Woolworths, like Coles, like say Commonwealth Bank, these are reporting entities because they are very big, and when me as a shareholder of this company, obviously we cannot go to this company and ask about what you are doing here, right? But how we can check about our investment, how we can sure about effectiveness of our investment is that looking at the financial statement. So they are a reporting entity. They are supposed to provide a bigger community of the users, including the shareholders, about the process, about the performance, about the position, financial position of the business. The conceptual framework also defines the 4 categories of users. The users which we mentioned earlier is expanded of those 4 categories which we have in the conceptual framework. The conceptual framework indeed is a sort of summary of those 8 categories of users which we mentioned in the form of 4 categories of the users. Indeed, define who are the users of the financial information. This is very important because when we prepare our financial statement, we should know that who are the users, because information should be useful for someone, that we call it as the users. Therefore, we need to know who are the users and then preparing those information for those users. And the conceptual framework states that it is concerned with general purpose. Why is it general purpose? Because the reports are prepared for all users. It's not any specific users. It is all users. That might be investors, that might be lenders. So based on their needs, these users can use this financial statement to concentrate on the issues or figures which they need to analyze and use for own purpose. It is not a special purpose, because when we refer to a special purpose, in general purpose, the entities, when the entities are supposed to prepare general purpose financial statement, that means those entities must follow exactly all relevant accounting standards. There is no exemption for the standard. They have to follow all the standards at once. But when we're talking about special purpose financial statement. These might be relevant to those entities which are not a reporting entities, but they are supposed to prepare financial statement. In this case, for the special purpose report, they are not supposed to follow all accounting standards, but those standards which the entities or the organization is supposed to do to prepare those financial statements. And again, in our unit and the other accounting unit which we follow, you follow in your course, basically the focus will be on the general purpose financial accounting, although at some stage you might need to know more details in regard to the special purpose of accounting. For example, for some of charity organizations, they are not supposed to prepare general purpose financial statement, but who knows, you may work as a chief accountant of an say charity organization. Then based on this responsibility, you should know about the rules which applies to the special purpose financial reports. Okay, how do we determine whether information is useful? When we're talking about useful, we're talking about quality, that whether information has the necessary quality to be used for our decision making process or not. So to determine the usefulness of the information, we need to learn about some qualities. We have two fundamental qualitative characteristics and 4 enhancing qualitative characteristics, and we go through this in this way. What are the 2 fundamental qualitative characteristics? First, we talk about relevance. Relevance has a very simple concept. That means all those issues and information which impact the decision or influence the decision of the decision maker should be reported in the financial statement. This information might be helps in predict the outcomes, that is sometime which comes in the future, or it might confirm of an outcome, that is something that has happened in the past. So the relevancy goes with this, the materiality of this issue. Is the information material? Is the information significant or not? If it is significant, that is part of the relevance of the information. That means we have to report in the financial statement. Otherwise, when it is insignificant, obviously, there is no need to report these items in the financial statement. Remember that a business might face with millions of transactions and events. Obviously, cannot report all these items in the financial statement, because otherwise the financial statement would be very boring and unreadable at all. So what we need to do as financial officers of our organization, as a company, is to summarize and select those to report individually when they are significant. Otherwise, we summarize all other information and we report in one way. When we report about sales, we do not report about individual sales, right? We say total sales, right? But when we report, say, for example, when we report about expenses, we report about expenses in total, right? But when we have a major, say, loss, say, as a result of fire, right? If this is the case, then we have to report this item separately. Although we say we do have these expenses, we have these losses, and so on. And besides that, we have to include this expense or this loss as a material, as a relevant information in our financial statement. It was a story last year, I think some of you have heard about this, about 7-Eleven. They had some tricks in the payment of salaries to their employees. They used to write a contract, say, for example, $20 per hour, but when they dealt with their employees, instead of paying $20, they asked to work 2 hours for $20. So on paper, it was per hour $20, but in real life, it was paid, the employee was paid only $10. It was complained, and the take went and disclosed to the public, and as a result, it created a big problem and big disaster for 7-Eleven. And what's happened? It was just only on the news the other day, I think earlier this week. 7-Eleven has to pay $157 million damages. So this is a material information in the financial statement of 7-Eleven. When they report the financial statement for the current period, this is a material, this is a relevant information which has to be included in the financial statement, which has to be disclosed separately in addition to other items which they include in their financial statements. Faithful representation, this is the other fundamental qualitative characteristics. That means the truthful of the information, the truthful of the honesty of the information which we report in the financial statement. These particular characteristics should be seen in from 3 aspects. Being complete, that is, whether it's a positive or negative, it has to be included in the financial statement, because if we had very good gain, obviously that might be reported as a very important items and material items in our financial statement. At the same time, we might have a big losses like the case of 7-Eleven. That has to be included too. Neutral, that means, again, similar to the earlier case, being positive or negative, we have to take into account all relevant information, regardless of the impact, and free from bias or errors. That means, obviously, we are all human. Sometimes we make mistakes, but as long as the mistakes are not intentional, as long as the mistakes are not intentional, obviously should be okay. But when we find the mistakes are significant, the mistakes are material and intentional, then that is a breach of these particular, characteristics in accounting. And then we have the enhancing qualitative characteristics, 4 enhancing qualitative characteristics. Verifiability. Deakin University assumed recorded this building, the cost of this building, say, for $2 million. It is there. When you go as an auditor, you ask, what is your evidence which you record this building for $2 million? Deakin University is supposed to provide you with some evidence, contract with the construction company or other costs which they expend to build this building to come up to $2 million. So that is the verifiability. That is be supported by evidence, be supported by source documentation, contract, invoices, and so on. Comparability. That means information should be comparable across the companies, across the industry. So the report which Coles prepare is supposed to be comparable with the report which Woolworths prepares. Supposed to comparable with Aldi supermarket report, because they are in the same industry, so they are supposed to follow the same standard, same method for the accounting of the operation and entities. And also consistency in the use of accounting standards and accounting methods from year to year. That is within an organization. Not only we have to be in a consistent and same, say, line with other companies in the industry, but also we have to take into account that has to be consistent within our organization year to year. So if we use, any depreciation account, say a straight line method for a particular asset, that means we follow this for the following year. So not using depreciation, straight line method depreciation for this year, and the following year we change it to reducing balance sheet and reducing balance and so on. So that is the consistency that companies must follow to make the information useful, to make information comparable. Timeliness. Information should be or must be provided to the relevant users on time. Otherwise, they lose their value. So any delay in some particular information, that means a big loss. And sometimes that can be counted as a breaching of law and regulation if this information is not disclosed on time. Understandability. Understandability means the information in the financial statement should be understandable by people who have reasonable accounting and business knowledge. So the company cannot say that this particular activity is very complex, therefore we would not disclose in our financial statement because our say users of financial statement could not understand this because it's very complex transaction. So this is not acceptable by accounting standard and it's not acceptable by conceptual framework. Therefore, we cannot make such excuse because the assumption is that the users of financial statement have reasonable and understanding accounting and business. All right, mentioned earlier that in accounting, in real practice of accounting, we have to assume and take some principles in our practice. Otherwise, we can't do accounting. Without these assumptions, without this principle in our practice, we cannot do a systematic accounting process. What are these assumption and principle? The first principle is accounting period. What does mean accounting period? Businesses are established for long run and the life of businesses are indefinite. Therefore, how we can measure the financial position and financial performance? According to this principle or assumption, we need to break the life of business to a equal period time to measure this, to measure performance and financial position of the businesses. The most common accounting period for the businesses is 12 months. In Australia, these 12 months usually start from 1st of July to the 30th of June in the following year. This is the financial accounting period according to the ATO here in Australia. In other countries, usually this goes with 1st of January to the 31st of December. However, the corporates and companies in Australia also are allowed to take any other 12 months for the financial statement. So it's not necessary for the companies. It's not necessary the financial year starts from 1st of June to 30th of 1st of July to 30th of June in the following year. They can any 12 months for the financial year, and that might be 1st of January to 1st of July, or any other 12 months which we have. This is relevant for individuals. As an individual, when we prepare our tax return, we have to stick with these 12 months. But when we operate as a company, we can select any 12 months as a financial period. Obviously, 12 months is a legal requirement for any entities, and in some entities we might have in addition accounting period. Say, for example, for listed companies, they are supposed to report twice a year, so mid-year and end of the year. Indeed, the financial period for these companies it would be even shorter, 6 months rather than 12 months. However, the accounting period or financial period for any entity has to be equal and consistent across the time of operation. Accounting entities, that means activities of the entities are separated from other owner and other businesses. Say you run a business, a cleaning business for yourself, and when you go to supermarket, you buy some detergent for your home usage and some detergent for business usage. According to the accounting standard, when you do accounting, you need to separate these two purchases, because the part which is belong to your business is not your personal expenditure, and the part which you purchase for your home usage is your personal usage. Should not be included in the accounts, although the business is yours, but in terms of accounting, these has to be separated according to the accounting entity. We have monetary, that is, activity is measured in one common currency. How is the application of this monetary? When we working in a particular jurisdictions, obviously, if the company works only in Australia, we would not have any problem, because all transactions are in Australian dollars, so the financial report will be reported in Australian financial report. But consider a company like BHP. They operate in many countries, right? And each country has its own currency. Therefore, the asset in those countries would be evaluated based on the currency of that company. In America, in UK, in Germany, or wherever they are, so they have their own currencies. So how BHP can report its financial statement, where BHP is an Australian-based company, and they have to, and they are supposed to report in Australian dollars. So if this is the case, then in preparation of the financial statement, they have to convert all assets, all accounting transactions, all balances into the Australian dollars, and report according to the and reporting in Australian currency. So that is the monetary assumption. Historical cost. We do have different bases and different foundation for valuation of our assets and transactions, but the fundamental and the initial assessment and valuation of asset and liability is based on historical cost. That is, for example, when we purchase a car, the historical cost of a car is that what we pay to buy a car. Later on, we might have a revaluation of the cost. That is the different base for the valuation, but initially that has to be recorded at its historical cost. Going concern. What is going concern? The going concern is an assumption that we continue to our operation in the next 12 months. That is because the way in which we evaluate our assets and liability is that we continue to do business and there is no problem for operation of the business. But if we find any concern, any issue with the going concern, that means the business is supposed to collapse in the next 12 months for whatever is supposed to be closed in the next 12 months, then that is not satisfied, going concern is not satisfied, therefore the value of the asset, the value of the liabilities might be different from when we assume that going concern is satisfied. And finally, we do have the materiality. In terms of materiality, we assume we will report, or we would report all information which are material. Materiality obviously has a definition, has a standard in Australian accounting standard, and this materiality or the issue of materiality is judged based on the standard of materiality. All right, this slide is just to show you how accounting assumptions are reflected in the financial statements or the notes in the financial statement. This is note number 1 for the Rubicor Limited 2016 annual report. Now let's highlight the points which reflect the accounting assumption and accounting principle in this report. We talk about accounting entity, and you see here the note to the financial statement defines what is the accounting entity. What is this report? This report is about controlled entities under the Rubicor Limited. So sometimes the accounting entities that might be a group, say for example when we talk about Woolworths. Woolworths is a group, it's not just supermarket. Supermarket is just one of the companies in the Woolworths group. So when we prepare and report about Woolworths supermarket, that is one entity. But when we talk about the Woolworths group, then we change the nature of this entity because it's not one company, it's a group of companies. And this is the case here. Rubicor is talking about a group that is a consolidated report. That means all reports of all entities belong to this particular entity is consolidated in one report. So when we see, say for example, financial statement as balance sheet or statement of financial position, that is reflecting the total group, not an individual. And this total group is our accounting entity in this particular report. Materiality. What is the basis of materiality is explained. This report explains what they take into account for the materiality. That is accounting principle and other regulation which they have to follow for reporting of material and significant items in the financial statement. And in terms of basis of preparation, that is historical cost, and then which expect for certain financial instruments which are carried at fair value. So this financial statement or this particular statement is telling to you that what bases are used to prepare this financial statement. The company says all transactions are recorded and reported based on the historical cost, unless otherwise for these issues or except these issues, which they refer to financial instruments or financial products, which they perhaps they included in their financial statement. In terms of monetary, this company says the report which we provide you is based on Australian dollars. So the asset might be in different countries, in different currency value, but they are all converted in the, into the Australian dollars. And then we have going concern. Assumes continuity of normal business activities. So it tells you whether you are a user, whether you are an auditors, that the company assumption is that they are continue to their life, to its life, without any issue in the next 12 months. So assets and liabilities has to be reported based on their book value. And then we have accounting period. This financial year for the company starts from 1st of July ends 30th of June. So other company that might be a different 12 months as I mentioned, but this particular company uses this financial period. All right, conceptual framework and accounting elements. This is very important point at this stage for you, because later on we all should take these concepts with us to when we analyzing transaction, when we talk about recording. The first things which you need to think about, what is the nature of this account? What element of accounting is this particular transaction? And that makes you very successful if you have a good understanding of these elements, and makes a problem for you if you couldn't understand this concept and take into account when you analyzing transaction. All right, now, what are the accounting elements? We have 5 accounting elements: assets, liabilities, owner's equity or equity, revenue or income, and expenses. These are the 5 elements. So whatever is the accounting transaction, the accounts which are involved in this transaction should be from assets or liabilities or owner's equity or revenue or expenses. Right? It can be out of these 5 elements. So we know the 5 elements, therefore we need to understand what, how we can define these elements. In accounting, to recognize an item as an asset, liability, or equity, or revenue, or expenses, we have to match the item with the definition and recognition criteria of the asset. Now let's see what are the definition and recognition criteria. We start with assets. Sometimes this particular definition comes in the form of multiple choice question. Some of you might see sort of question from this particular slide which you see. How asset is defined? A resource control. So this is the first character, is controlled by the entity as a result of past events. So control past events, and from which future economic benefit are expected to follow to the entity. So 3 elements which we can simply realize in this definition. That is a resource control, right? This is one character of the asset. Remember that here we're talking about control, not about the ownership. We can have asset without ownership. That is the case which is sometimes it causes problem for when we are not familiar with the accounting context. The ownership does not a criteria for recognition of asset, but its control is the criteria rather than ownership. So we might later on we will talk about why we talk about control rather than ownership. So control, one, that has to be as a result of past events. So for a transaction in the past, we get this asset or control of this asset, and in the future we expect to have economic benefit of this asset. So this building belongs to Deakin University because not only have the control but also the ownership obviously for this one. So the control is that the past event? Yes, because they built this building, they paid, and this is resulted as a past event. From which future economic benefit? Can we expect future economic benefit of this building for Deakin University? Of course. We are here because you pay fees, and this is an earning, and this is a future economic benefit for Deakin University. So this building is an asset. According to the definition which we have in the conceptual framework, this is an asset because it is satisfy all these three definition criteria, although definition criteria are necessary but is not complete for recognition of asset. I explained this shortly. Liability, a present obligation of the entity arising from past events, the settlement of which is expected to result in an outflow from entities of resources embodying economic benefit. So clearly we can see three criteria. That has to be a present obligation, that has to be arising from past event, and that has to result to in outflow of the entity's resources. So three criteria here again: present obligation, past events, and resulting to outflow of economic resources. So when we define liability, the liability should be seen as satisfy all these criteria. And the equity is defined as the residual interest in the asset of the entities after deducting all its liability. So we have assets, we have liabilities. The bottom line, whatever is the remaining, whatever is the residual, is the owner's equity or equity for the business. So make very simple. Your asset is $1,000, your liability is $500. How much is your owner's equity? $500. Okay? That is a very simple context, and you can take this putting in the context of accounting equation, which we will talk about shortly today. Income. How we define income? Income is defined as increase in economic benefits during the accounting period in the form of inflows or enhancements of assets or decrease of liabilities that result in increase in equity. So enhancement of assets. Asset can be in any form. It's not necessarily in the form of cash. It can be in any form. It can be account receivable. It can be land. It can be building. It can be equipment, whatever. So we are not talking about a particular type of asset. We are talking about general asset. Increases in economic benefit that it can come in the form of asset during the accounting period in the form of inflows or enhancement of asset, or decreases of liabilities that result in increase in equity. Again, put in the context of how we define equity: assets minus liability, that is equity. So any increase or any revenue increases the owner's equity. That is a definition or the definition of income. And then other than, that is important, other than those relating to contribution from equity participants. So when we issue issue of shares is not an income for the business because this is a contribution by the shareholders. Therefore, we should not or we could not record this as an income. But when we make a sales, obviously, that's the income. When we provide service to our customers and we charge our customers, that is an income for the business. Expenses is in opposite way of the income, decreases in economic benefit. So when you compare, you see that exactly in opposite way. For income, we say increases, and for expenses is decreases in economic benefit during the accounting period in the form of outflows or depletions of assets or incurrence of liabilities that result in decreases in equity. Other than, and again, that is the point which you need to notice about this, other than those relating to distribution to equity participants. So dividends, payment of dividends to the shareholders of the company is not an expense because this is a distribution of equity to the shareholders. It's not an expense. Whereas when we pay interest, that's an expense. When we pay for electricity, that's an expense. When we account for depreciation, that is an expense. But again, when we pay dividends to shareholders, that is not obviously an expense. It has to be accounted under the equity transaction. When we consider an item to be recorded in the accounting books, we need to determine whether this item is asset, liability, equity, income, and expenses, and go through these criteria which we have, whether they satisfy all these definition criteria or not. If they satisfy all these definition criteria, then we have to continue these criteria or continue this assessment with these two recognition criteria. The recognition criteria, one is probability, the chance of occurrence. If the chance of occurrence is more than 50%, we would say that is a probable, and we can record this item as an accounting element in the books. Otherwise, we would not be allowed to record this as an accounting element. And the second recognition criteria is measurability. Can we measure the transaction? If we couldn't measure the transaction, how we should report and how we could report in our financial statement. So that's very clear that this has to be satisfied. The measurability has to be satisfied. Otherwise, we could not record and report these items in our financial statement. At this stage, you might be again a little bit confused that how measurability can be a question. Obviously, for making a purchase, we don't have any question about measurability. When we borrow from a bank, we don't have any question about the measurability. When we do have calculation of interest, obviously we don't have any question about a measurability. But when we go to a more complex transaction, say a mining issue, a research areas issues, then we would have a lot of complexity there in terms of whether this is measurable or not. We will talk about this later on in more details in, I think it's in week 6 or week 7. All right, we take the same